Hi, it's good to be back again for the afternoon session. We're going to be talking about rates and gold and inflation, as you just heard a moment ago. And the central bank intervention began about a decade and a half ago around the GFC. And as we sit here today, global rates were pushed to zero. The major central banks' balance sheets were just shy of $30 trillion. And to not think that that did not come with some consequences, you're somewhat delusional. So we're going to solve for all of that in the next 45 minutes. And as a precursor, maybe not to bias any of the views in the panel, I asked Siri what's worse than a taper tantrum, and she came back with taper meltdown. So I don't know if that's where we're going to be going from here, but maybe we should start with very quick introductions and then we'll get things going. Joe?
Great, thanks, Bill. It's great to be here. It's Joe Cavatoni with the World Gold Council. We're a global organization, member organizers for the mining companies. Our goal is to promote gold, to raise awareness, do policy work, really bring it mainstream into investment, consumption, and really make sure clients and investors are aware of the asset and bring it into their portfolio. Been with the firm about 5 years prior to that with BlackRock.
Thanks, Joe. Tom?
Tom PLUTA, JP Morgan. I run a sell-side trading business, and I've been there 27 years trading and managing traders across macro markets.
Thanks. PUTRI?
Hi, PUTRI Pasquale. I'm with Angelo Gordon. I lead the effort on strategy and product for multi-strategy credit and CLO platform. Before that, I was an allocator.
SUBADRA?
I'm SUBADRA Rajappa. I'm the head of rate strategy at SocGen. I've been at SocGen for 6+ years. Prior to that, I was at Morgan Stanley and Citigroup. I started my career at Salomon Brothers in the late 90s.
Thank you. So, Putri, maybe I'll start with you. We talked about inflation, and it was sustaining maybe at 2 to 4%. Now, maybe sustaining at 8. I don't know if that's transitory or not, but where are we in the inflation cycle?
So the interesting part about the switch between transitory and now, I think we all have accepted that it's more permanent. It's in the strength of that labor market. The issues surrounding the supply chain is perhaps temporary, so that 8% may or may not be here for a long time. However, I think where we are in terms of where we are versus 2 to 4%, we are likely going to be above that, just because some of the pressures on the wage front and the labor front continues to persist.
And maybe just sticking with you for a moment, so the supply chain, it was all about COVID at one point, but now the war in Ukraine has brought additional kinks in there. So there might be some things that are not necessarily in the central bank's control. So how does that factor into the outlook?
So that's for investors who come from the fundamental side. That's the challenge, because whenever you go back to your model and you're trying to reprice that risk, your model is highly sensitive to some of these inputs now, and sort of in a statistical nerd parlance of confidence interval, your range has just gone up. So your confidence interval is much lower. And it's anybody's guess of what's going to happen with the war in Ukraine and how long will that impact last, especially with European energy pricing. But what we do know from the fundamental side is that the issue of underinvestment in certain areas, infrastructure of energy, that's something that has been in the market for a while, and that's going to take a while to fix.
Did you want to say something?
I think I'll just jump in, and you wanted to have this as a living room dialogue.
Go right ahead.
I think it's a really interesting point. I think we didn't see the potential for the significant amount of effects that the Russian impact would have. I think the sanctions the Russian invasion of Ukraine has had on things. Sanctions on Russia have put in place significant concerns around the commodities that they are a large producer of. I mean, they are one of the largest producers of commodities worldwide, whether it's wheat, whether it's sources of energy, whether it's precious metals, whether it's nickel or palladium, whatever it might be. Those things are creeping into the system. So whether inflation is transitory or here to stay, you feel it a lot more. So the reality is you have to see that risk. You have to understand that conflict in the Ukraine, no one knows how it's going to end, and no one's really going to understand until it happens the effects of how sanctions are going to unwind, and we're going to re-allow things to come back to normal. So we're dealing in this world of just continued and ongoing certainty. I mean, prior to COVID, we had warnings out in our outlook about frothy markets, geopolitical risks, but never would we have ever imagined they would be so substantial as they are today.
So Tom, maybe building in that theme that Joe and PUTRI just mentioned, it's often a question of what's priced in and where we are vis-a-vis rates or however you want to look at it, because the market has a tendency in the short term to be more of a voting machine, as Ben Graham said, and it figures out things over time. But what is priced in and what are your expectations?
I think I'll back up and just kind of add to the comments on inflation first. While I agree that the Russia-Ukraine situation, completely unexpected, and the supply chain stuff added a lot. I think where this inflation problem came from was from the actions that the federal government and the Fed put in place after the pandemic, right? So, rewind to spring of 2020, we had an economic crisis, we had a markets crisis, and the Fed and Congress acted very swiftly and decisively. And at the time, what they did was very necessary. People were out of work. They started with fiscal stimulus, putting money in people's pockets. But then the Fed, they dusted off some of the playbook from the GFC, cut rates to zero, restarted QE and other programs to support credit markets, mortgage markets. All that was necessary at the time. But then as the markets recovered much more quickly than anybody expected, they continued with the stimulus, they continued with the monetary and fiscal stimulus that led to this inflation problem. So the Fed, about a year late, I would say, realized they had a problem where the inflation wasn't transitory, continued to run away, and then had to turn around and flip from QE to QT and start raising rates. It's pretty shocking that given the level of inflation that we're at, they were still actually buying bonds in March. So now they're hiking rates. They've hiked 150 basis points cumulatively in the last 3 meetings, and we're priced for another 175 to 200 by year end. So about Fed funds will be around 350, or at least that's what's priced by year end, and we see peak Fed funds about 375 early to mid next year. That's what's priced.
And maybe just the global aspects of this too, Tom. So around the GFC and then also around COVID, the large central banks kind of moved in unison. Is that going to have to happen as we come into this next phase? Because the focus seems to be on the Fed, but as I said earlier, collectively, the big four are at 29 trillion, and I think the Bank of England has some massive inflation problems, maybe bigger than the US right now.
Yes, it's happening globally. It's not in lockstep. They're going at different paces. The emerging markets were the first to go. I think they were quite concerned and prudent about what was happening. Their currencies were depreciating. Inflation was even more rapid in those countries. But yeah, the major central banks are all hiking. The outlier is Japan, who has not given up their zero rate policy yet. But yeah, they're all on the move right now.
So, SUBADRA, can we possibly stick the landing without a recession? I don't see how that's possible, but you're more informed than I.
Yeah, no, that's a very good question. I would say that, at least historically, central banks haven't had much of a track record, if you will, in being able to orchestrate a soft landing. And I think this time it's very, very tricky because the sources of inflation that are plaguing the market right now, the supply chain disruption, the labor shortages, higher rents because of a shortage in housing. These are not necessarily, sources of inflation that the Fed directly controls. So if you look at the broader spectrum, the one thing that the Fed can do and will do is raise rates, quite dramatically in a very short amount of time. But raising rates and monetary policy tools that they have in place, it's a very blunt tool. And what that's going to ultimately do is slow down the economy. Perhaps it'll disincentivize consumers from going out and buying aggressively. Part of the reason why we've had higher inflation is because consumers have been very actively buying because they've had stimulus checks, excess savings that they're putting to work. So this is kind of a supply and demand-driven inflation episode. So to some extent, some of that froth will get taken out of the market. You could see some froth in the housing market that gets taken out as well because mortgage rates right now, 30-year mortgage rates are north of 6%. So that's definitely going to kind of put the brakes on the housing market. But broadly speaking, the Fed cannot really do anything directly to impact supply chain disruptions. They cannot do anything on the commodity front. For instance, issues with Russia are going to persist well beyond the war in Ukraine. Let's assume that the war, ends in the next week. You're not going to see this commodity issue really be addressed in a meaningful way, and commodity prices aren't going to really reverse course, because this could be the beginning, if you will, of demand moving away from Russia, and generally speaking, if you look at the move to ESG or other types of alternative sources of away from fossil fuels, you're still going to see that you're going to need a lot of commodities for that transition to happen. So I think that broadly speaking, that all of these sources of inflation are not something that the Fed is going to be able to directly address, which means that they raise rates and they're going to slow down the economy quite dramatically without being able to directly impact the sources of inflation that are affecting the market right now.
So maybe then we can talk about what should an investor do about this. And I don't know if there's a safe haven here, but maybe you can talk about some of the options. There was a lot of liquidity on the investor's balance sheet coming into this cycle. And now after thinking about rebalancing, cash might be a place to be, but with inflation sustaining at 8%, it's a horrible place perhaps on a real return rate. But Joe, gold is talked about quite often, and maybe it's a concept of winning by losing less, perhaps.
Correct. And at the risk of sounding like the barber that's going to tell you need a haircut, actually I'll cite a survey that we've done for 3 years running now with Greenwich Associates, basically going out to 500 professional investors, asset owners, real money accounts worldwide, and really getting their take on how they're seeing their portfolio, what they need, and how they need to manage to help them. And I think one of the biggest data points that we get back is the max drawdown concerns that they have, the shocks that come along with the portfolio, in addition to trying to find an allocation of safe haven. So I think in the context of gold, as a unique commodity, it actually does really well when wealth is created. People actually spend as a consumer. It does well when people are concerned. People save. It's a nice way to save. It's savable around the globe, whether it's in the form of a jewelry purchase in an emerging market or in the form of an ETF in a developed market. But it does well during both of those economic cycles. So when we talk to this community about how and what you should be thinking about with gold, they understand the safe haven nature of it. They understand the long-term projected returns, roughly 4%, the historical returns. They like the diversification benefits, but they also see that gap down risk of moments in time where they can sit back and say, look, I feel good, because if you look at gold for the last couple of weeks, we're flatlining. It's doing exactly what it's supposed to do. Pretty boring. Everything else is gapping down and it's holding its own. So it's a safe haven story, but it also has that protection during those drawdown moments.
And then the impact if everybody's moving to the reserve currency and the dollar is getting stronger, what's the impact there on gold?
Well, dollar strength is definitely going to be some headwind for gold, but this is not just a U.S. phenomenon. I think we've got global issues. I think you talked about the UK. I think you talked about EU. I mean, these are emerging market issues. These are all happening at the same time, and it's one thing that keeps the asset buoyant in terms of a price is the fact that it is globally driven in terms of its demand profile. I think the one thing that hasn't come back on is true retail in markets like India and China.
Tom, tips as an example. Do you see places that make sense for you in this cycle?
Yeah, tips have been a very popular investment. So that's Treasury inflation protected securities, for those who are unaware. But it obviously pays a return plus inflation, so that will clearly keep pace. The other thing I would say, I mean, obviously it's been a really tough year for all asset classes. There's really been nowhere to hide, except gold, I guess. But cash is becoming an asset class again, right? So, as I pointed out, if Fed funds is 3.5 at year end, you'll be able to get a real actual yield again on money market instruments that will allow people to allocate a portion to cash again while some of these other things play out.
Putri, private credit is another one I hear about. That market did not exist at the time of the GFC. It's now maybe $1 trillion, to pick a round number. Do you see opportunity there? You've got to be careful, obviously, chasing a yield. There's a credit behind that, but how would you look at that market at this point in the cycle?
So a couple things that investors can do. One is beyond your asset allocation to different betas. This is the time to really rethink your alpha. And in private credit, one of the things that I think structurally beneficial is the drawdown structure. So you can think about who are the players that you entrust and who have had track records in terms of adding alpha, because that security selection is really, this is the kind of market where you can shine by having a differentiated point of view.
And Subadra, you mentioned the commodities. Maybe the CTA, this is their day in the sun. Is there any, the CTA specifically, or anything else you like in this part of the market?
Yeah, no, I mean, I think I'm going to second what Joseph was talking about, which is ultimately, at least for my space in rates, it's all about the safe haven bid, right? I mean, we actually have in my presentation deck, I have a chart that shows gold versus 10-year TIPS real yields, and 10-year TIPS real yields have risen quite dramatically because of the rise in generally in bond yields because the Fed's been very active, but gold hasn't really risen in tandem. I mean, declined, or I should say, the correlation between the two tends to be that both gold and real assets appreciate at the same time, and you're not seeing that because gold is still a safe haven asset, and bonds have not been really a safe haven asset to offset your losses in equities over the last, I would say, since the beginning of the year, because bond yields have risen quite dramatically, and so has been the decline in equities. So I think as yields rise, I think yields across the board, both treasuries as well as even corporate bonds or high yield, are going to look attractive if default rates don't start to rise. So, for me, this is ultimately, the safe haven bid will return to the rates markets once you start seeing a little bit of a stability in the risky asset complex, as well as, policy sort of coming towards the end.
So, go ahead, Joe.
Just very quickly on ways of access. I think, the markets are at probably the greatest point in history in terms of your ability to access commodities through a number of different mechanisms. So while CTA is one option, there are exchange-traded funds. You can buy commodities direct. There are futures contracts around the globe. I mean, it's a huge, wide-open market, and mechanisms for access are plentiful. Large firms, like the ones I'm sitting here with today, can offer you access to all kinds of commodity exposure pretty easily.
And I'm sure you've gotten this question before, Joe, about cryptos versus gold. And it was argued that cryptos could be a store of value by some, and we've seen the Bitcoin track below 20,000. So how does that factor in, or where do you see that in the mix?
It's pretty simple. It's a discussion we no longer have. I know there was a fun ad that was put out. There was a lot of positioning around what cryptos were, whether they were a form of currency, a form of payments, the state, replacement for gold, the safe haven asset, an inflation hedge. I think, as of today, I think they've proved to be none of those. I think the technology underpinning all of it is fascinating. Blockchain technology is amazing. And ability, I think the panel before, 2 panels ago, they were talking about what it could all mean. Sure, you could take out high levels of inefficiency for moving any asset around the globe. But right now, what you're looking at is a speculative asset that tracks like a technology company and has correlations that look an awful lot like NASDAQ, not like a safe haven asset. So I think the conversation and the data that we put out and the research we've got, you can take a look at it. We've built it all on the basis of real numbers and actual analysis. You can see that they're different assets.
And the crypto winter, we're not even halfway through?
I have no idea. It's a risk asset. I'm looking at safe haven assets.
Tom, all of what we talked about thus far requires resolve, and we are going to be in for maybe some painful quarters ahead, and blinking is maybe the easy way out, but it's not going to get us through the other side. We're going to test the patience of central banks, test the patience of asset owners, of asset managers. Do we have the resolve to get to the other side of this?
Well, we'll get to the other side one way or the other, but I think when you get into these questions of, where do we go from here, and like, are we going to have a hard landing or a soft landing, or recession? I think of it in terms of we've just accelerated these market and business cycles, right? And we've been through a very compressed cycle. We obviously crashed down in spring and summer of 2020, and then due to all of the policies that were put in place, this rapid, massive recovery. And then they let it run too hot, and then we overshot, and now they're putting on the brakes much more rapidly than we've ever seen, or at least in 40 years. So yeah, we will get to the other side. I do think that the central banks finally are figuring it out, and we're going to take the medicine, and we're going to take the pain. And I do think that there could be more pain from here, but I think that we're closer to the end of the sell-off as the market sentiment couldn't be worse in all of these asset classes, and the pricing is at a level that is much more reasonable than we were even 6 or 9 months ago. So yeah, we'll get to the other side. I think the central banks know that they have to dole out the medicine, and it's just a matter of how long it takes to shake out.
And I assume that the earnings and maybe the statements of these public company CEOs are going to be very important, the quality of those earnings, and maybe even more focus on the balance sheet of these corporates in terms of their ability to have liquidity.
Yeah, I think so. I mean, I'm not an expert on equity markets or corporate balance sheets per se. However, there's been a very significant re-rating. PEs that were at the very high end of the range that we've seen are now back to historical averages. So you can take comfort that there's been a lot of mean reversion, there's been a lot of retracement. I will say this, I do think that the corporate balance sheets and bank balance sheets are in a much healthier place than they've ever been. And that's one of the good things that came out of Dodd-Frank. I don't think we're going to head into another sort of financial crisis as far as driven by banks. They're in really good shape. It's really been sort of a painful market adjustment more than anything else.
So, Putri, to pick up on Tom's point, I 100% agree with what he said. But what's happened is the creation of all these shadow banks, and all the lending has been pushed off the bank's balance sheets. All the mortgage origination, to a large degree, is off their balance sheets. And we used to worry about the 2A7 money market fund breaking the buck, and now it's happening almost every day with stable coins, and there's no Fed to come in, and there's no FDIC insurance for banks. So how big of an issue is shadow banking, and do we know enough about it to assess the risk?
So when you look at the non-bank financial institutions, so one of the biggest issues in the last crisis was the mismatch between assets and liabilities, and that the classic of you're putting illiquid assets in vehicles that have much shorter liabilities. And if you look at where the capital is in a lot of the credit providers today, a lot of the funds from the asset management side have match that, so that's less of an issue. I would be the first to say crypto and sort of the fintech area, I would defer to the experts, many of whom are in this room. I'd be interested to see where that shakes out. Perhaps like a lot of, we've seen this movie before, whenever there's a new product or new strategy, the market sort of comes and allocates capital and sort of a shakeout happens, and we see who the winners and the losers are. So I'd be interested to see in that space, particularly crypto, what comes out of this.
Did you have a follow-up?
Yeah, just so picking up on the stable-backed coins or coming around the crypto space. So we've been doing a lot of analysis at the council because we're working with the industry about exactly how can technology take a step forward to improve the overall efficiency of commodity markets in general. And I think people need to just be super careful when they start looking at vehicles that are purporting to do certain things. So a lot of us come from regulated backgrounds. Maybe we're old-fashioned, maybe we're the older generation, but a prospectus has meaning and has a lot of content that's important, and it gives the confidence to the consumer, which is really at the heart of what's happening in the crypto space right now, concerns around the consumer. It gives definition to things, it lays out risk, it lays out profiling of how operational procedures operate in these vehicles. And just having a white paper that's 3 years old and evolving it because the technology will allow you to do it with a vehicle to get you more and more return and leverage doesn't mean it should happen, and doesn't mean that people should be taking them as a replacement for money markets construct. And breaking the buck was a real deal. And actually, it's a shame that it's happening again, and it's a shame that people are falling for it again. People need to do their homework on these vehicles and understand what they're buying. And I was a little flippant around the comment about the crypto winter. I think we're going to just continue to see more and more of these vehicles prove that the technology is faster than the construct, and that they're going to continue to show weaknesses and failing.
And I don't know where we are then on that vis-a-vis regulations. SUBADRA, I don't know if this is your area of expertise, that regulation often lags the crisis. Something bad has to happen, and then usually the pendulum swings too far the other way. But some of these areas we'll talk about right now are either not regulated at all or under-regulated in terms of really trying to not protect the investor, but maybe protect the investor through greater education and awareness about what they're buying.
Absolutely, and I think that I come from, like what Joseph was saying, a very regulated market. We've had, banks are extraordinarily regulated on the liquidity side. We have liquidity coverage ratios and supplementary leverage ratios on the capital side. So banks are in a very, bank balance sheets, broadly speaking, in a very strong place. Money markets as well. I mean, we put all of our money into money markets. They're extraordinarily well regulated. After the great financial crisis, there's been a lot of work that's gone into regulating money funds, broadly speaking, so that they don't break the buck. These new technologies are trying to, in some respects, give you the same sort of exposures and same sort of vehicles, whether it be a safe haven asset or an inflation protection vehicle using crypto. But broadly speaking, you need the same level of regulation. It's maybe not the same level, but some sort of regulation, going forward, so that we don't repeat the mistakes that we've made in the after the great financial crisis with banks as well as with money market funds, breaking the buck.
I'd look at four locations. Sorry, go ahead. I cut you off.
Well, I was just going to add a little bit. I think SUBADRA highlighted really well that we do need more investor protection in place. The other side of it is I'm fairly close to what's going on with the efforts to clarify regulations for banks. Obviously, the big banks want to get into this space, but it has yet to be defined exactly what they can do. Right now, anything crypto-related, even custody, would be perceived as if would be treated as if it's on balance sheets with a very punitive capital charge. So it's really prohibiting banks from getting in at all, but there's a big effort to really clarify what they can do because, banks are highly regulated, risk managed, overseen very closely by both prudential and market regulators. So I think that could be a stabilizing mechanism if they were allowed to get in and provide a range of services in the digital asset and crypto space.
Great point. And all I was going to add to what's already been said, I think there are 4 places to look for what's going to be developing around regulation. Obviously, here in the U.S., Senators Loomis and Gillibrand have put out a bill, the first bipartisan bill that's attempting to define crypto, attempting to define a stable coin. It's going to get a lot of attention, a lot of criticism. It's going to get a lot of likes. It's going to get a lot of really important action. It hasn't gone beyond those 2 categories right now, but I think it's definitely a space to watch. MiCA in the EU is definitely a place to watch. The UK as well, and Singapore. All these things are developing slowly and carefully, but I think that those 4 regions would be where I'd watch for regulation and regulatory developments around how crypto, stable coins, and maybe even tokenization of an asset itself will develop over time.
And I think, Tom, I want to come back to something you just said a moment ago about the banks coming back. And I don't know if they're going to get back into the lending business, but if you think about this, the DeFi concept, I think it's made the markets maybe more accessible to a lot of individuals, but you have people with technology backgrounds coming into the financial services space, and maybe they don't fully understand the role of a fiduciary. So I think there's going to have to be some kind of a marriage between the technology and maybe some of the big intermediaries. And I don't know how that happens. Does it happen through M&A? Does it happen through sort of organic growth inside of the banks? How do you see that playing out?
I think it's both. At JP Morgan and other banks, they're trying to build in-house expertise and dabbling around the edges in some of these things. But we're also looking at partnerships with a lot of the upstart companies, either through investments or other types of collaboration. So I think it's quite exciting. I listened to a lot of the earlier panels, and it was fascinating to me, all the different things that people are doing in this ecosystem. And, there was definitely an acknowledgement that, hey, some things definitely went wrong, particularly over the last few months. The Celsius and Luna Terra debacles. I think if none of this happened, if things were properly regulated and overseen better, it wouldn't leave the stain that's now, I think, impacting the whole the whole asset class. But eventually, and as others mentioned, it will get cleaned up. The bad companies and the bad protocols will get cleared out, and the stronger ones will remain.
Putri, I think the news cycle and maybe the human mind can only withstand a couple of crises at once. And it's amazing just to look at Ukraine. I'm sure the atrocities going on there today are as bad as they were several months ago. We don't really talk about it so much anymore. And the same with ESG and climate. Now we're talking about where oil is at the pump and how ExxonMobil is doing. Have we forgotten some of these other issues and challenges that maybe the central banks need to be thinking about as well? Because if we're going to solve for climate as an example, it is going to require capital, and it's going to have to come from the sovereigns to some degree. So is the short-termism, I guess, to form this into a question, that seems to be maybe at the root of it is some of these same central banks.
So one of the interesting issues as investors is your investment horizon. And I think this market today reminds you the old adage that the market can stay irrational longer than you can stay solvent. This is very true, and I think a lot of people are living through that. The fact that there's particularly a lot of things in the risk horizon makes the job of an investor difficult. And between geopolitical, we've talked a lot about that, and also what's going on with the Fed and the pivot on policy. I just wanted to go back, I think in terms of adding alpha to the portfolio, the value of having real option and optionality, being nimble, because if I go back to, I lived through the 2008 GFC and the world after that, what is different today is that the cycle feels a lot faster. In GFC, I lived through a few asset classes that went down and then recovered. You could get in the trade 3 to 4 years after the GFC, and there's still juice in that trade. Your numbers are still pretty good, and that's no longer true today. And it feels like sort of that V down and then back up. I think Tom referred to the incredibly quick recovery. It's a lot faster. So in order to be able to, first of all, you can only fully play offense if you are not digging yourself out of a hole. So portfolio construction, that's really important. How do you think about participating on the upside and also protecting on the downside, and thinking about what strategies you have in your portfolio that can enable you to do that? And regarding short-termism, I'm not going to complain about young people, because I'm positive that the sign of me aging is when I complain about the young generation. So I'm not going to do that. But I think it is particularly difficult. And I believe somebody interviewed, Ken Griffin, and he said, my crystal ball is dark. And if, somebody of that caliber, and I think that sentiment that is echoed by a lot of big investors with very successful track record across different cycles, and if they feel that this is a particularly difficult environment, I think real optionality, so you could be nimble, and the ability to execute on your game plan on a much quicker basis, because the cycles are going to be much more micro. I think those are some of the things that you need to have in your back pocket in order to navigate this through this next environment.
So Joe, just staying with the ESG theme for a moment around just mining of some of these minerals, have there been more efficient ways of doing that, or is that always going to be an issue?
Well, so let's just take gold, because that's the space I know best. Probably 98 to 99% of carbon impact is a source of the problem of the mine. Basically, that's where it happens. By the time you get to a precious metal that's in bar form, sitting in a vault, it has no impact on your portfolio. It actually is one of the best assets to add to a portfolio once refined. So the mining sector, in particular in gold mining, has had to take its own initiative to get itself organized, else they will be behind the eight ball. The types of things they're doing, they're working towards their own standards. We've worked to put in place a responsible gold mining principles with our member firms, 34 firms worldwide, a glide path to 2023. The mining companies are actually focusing in on social as well as the environmental issues as much as they possibly can. Things that they're doing include the introduction of renewable energy sources, They're also looking at electric vehicles. I'm not sure exactly, I guess the autonomous driving vehicles is what they call it, but basically that type of activity, as well as actually reinvesting in communities. So they're doing all the right things to fit in and actually stay selected or not excluded from any of the different screens that are being applied worldwide. But it really takes an immense amount of energy on their part to actually get organized and actually build their own principles and build towards it, and then carry the message out. And I think it starts really with the governance part of what needs to happen with the mining space. Overall, I think commodities are actually going to struggle. I think there's a lot of work that needs to be done. There are a lot of organizations that are putting out guidelines and rules that just don't necessarily bode well for all sectors.
So if I bring this back maybe up to the macro level, Subadra, I think part of the outlook has got to be lowering your expectations, either nominal or real. And if I think I saw a stat recently going back to 1926, the 60-40 portfolio has compounded at just shy of 9%. I don't know if that's going to be the case the next 5 to 10 years, but is part of what all investors need to be thinking about is a more realistic base case.
Yeah, no, I think that the key question for me forward is not so much what we already know, which is higher rates, higher inflation, what the Fed's going to do, but how the economy is going to react to all of these different variables that are currently in front of us, whether it be the war in Ukraine, whether it be much tighter monetary policy, whether it be much stronger gold and what the impact, much stronger dollar and what impact that's going to have on emerging markets. Broadly speaking, the China's COVID zero policies and how quickly China will sort of work its way out of it, and global recovery engines will start taking hold. It's a question for me here on is how is this all going to play out? So it's and to me that's really where the biggest debates in the market are. Is as the Fed starts raising, how quickly the economy will slow down. To Putri's point earlier, I think what we're looking towards going forward is a much shorter cycle, right? It's not going to be like the last 10 years where the Fed cycle was 10 years long. I think it's going to be much shorter, sort of a little bit more of a boom and bust cycle, if you will, in the rates markets as well as Fed policy, because they're raising rates so fast, they're going to slow down the economy a lot faster. And that's going to result in a much shorter cycle. So we're just going to have to recalibrate our portfolios for that sort of regime, because we've gotten used to this environment of low inflation, and 60-40 portfolios have all been sort of working the same way, where equities have been rallying and bonds have been rallying. Now you're going to need a little bit more differentiation, perhaps a little bit more active portfolio investing, perhaps stepping away from sort of an indexed approach to the portfolio. So I think that's really where I think active strategies get to be much more important going forward. And just overall, as investors, we just have to be a lot more nimble in this environment, because not only are we dealing with an environment that central bankers don't have a handle on, regulators don't have a good handle on, governments don't have a good handle on from a policy perspective. So things could change very quickly. So we just have to be very nimble in the way we look at our portfolios and how we allocate our investments.
So we just have a couple minutes left before we move to closing comments. It's hard to have any panel and not talk about politics, so you're going to be my victim here, Tom. So we have midterm elections coming up, and Joe used the word bipartisanship. I'm not even sure what that means anymore in Washington, D.C. But how should an investor be, or a strategist be thinking about that vis-a-vis inflation and rates? Does it have some impact, no impact?
Well, probably not a very bold prediction to say that both houses of Congress are going to flip to Republican control. The betting markets will tell you that's probably at least 80% likely. I think it's close to 100% likely. Then you need to think through how will that feed through to policy. Should be more market friendly, quote unquote. As far as what it might mean for things like Fed policy, that's really not going to change unless in 2024 you flip to Republican president. Maybe they'll put in someone more market-friendly or dovish. Yeah, that's the view. I think it'll be modest as far as 22, as far as as policy, but could shift more after the presidential election.
Okay, terrific. So maybe, Subhadra, starting with you, if you want to just put a ribbon on this discussion for the audience and a wrap-up observation.
Yeah, no, I think there was a lot of interesting takeaways for me as well from listening to my co-panelists. But really, I think what I'm focused on from my perch is policy. What's going to happen on central bank policy, not just in the U.S. but also globally, and what impact is going to have on the broader economy and perhaps the potential for a recession in the next 12 to 18 months or even sooner, and what kind of investment strategies make the most sense. To me, at some point, I think you're going to see a resumption of the safe haven bid for treasuries and fixed income assets, and perhaps a return of the 60-40 portfolio allocations after the correction we're seeing in the market right now.
Thanks, Subhadra. Putri?
From everything that I heard both on this panel and today, that the left tail particularly of different outcomes is fatter. So in order to try to navigate that, some things that we can think about is alpha, not beta, and that flexibility in terms of being nimble as the facts change or the market changes is one of the things that investors can do.
Well, there'll be a lot of inefficiencies, which is the home of alpha, so I think you might be right. Tom?
Well, when I think of the current market that we're in, I think of that adage, history doesn't repeat itself, but it tends to rhyme. We've been through this before. We've been through bust and boom, euphoria and then crashing down. Things clearly weren't as good as markets were pricing when inflation was rising, but we had 0% short rates and equities were at the highs and, crypto was at the highs and everybody was partying. And equally, when things come crashing down, it feels like the world's ending. It's not, right? We're reverting to means. Things are normalizing. They will stabilize. I do think we're closer to that bottom, and then hopefully, things more normal activity will resume and things will recover.
I love an optimist. Awesome. Joe, final word.
So I think everything that's been said is fantastic. The only thing I'm going to add is prepare for not only those moments of hitting that bottom, but the shocks that come along with the ride. So look at an asset from a safe haven perspective that will actually perform well when you need it to, the kind of diversification you want, but also can hold water during those shock moments. Because I think if there's anything we've learned, we just keep having these shock moments in our lives.
Indeed. Well, a good wrap-up, good discussion. Please join me in thanking the panel.